The angle of attack has changed. The Fed has said this is not going to be some triangle sawtooth. It's not going to go up sharply and then come back down sharply, which is what we would all want if we wanted things to get back to normal sooner. The angle of attack is now a little bit slower, which means it's going to take longer to get where we need to be. And then we're going to stay there for a lot longer than we want. And when you roll those two things together, a lot of companies may run out of money.
Hey guys, welcome back to Library of Wealth. Today we're checking out Chamath on the All In podcast, giving us a market update, as well as the changes that are happening in the economy. Chamath says that because the Fed would rather overcorrect through rampant inflation, he's planning for the worst, which he believes could last until 2025. In the meantime, Chamath is looking to capitalize on the private market, but he's concerned with the amount of uncertainty that exists right now because these companies may be reluctant to revisit their valuations during a downturn. He's looking for companies to make cuts now rather than 18 months down the road and then realizing how much more expensive or hard it's going to be to do business. Let's listen to Chamath as he gives us his market prediction and what economic impacts the Fed will have in the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
And so if you can't get to default alive, you have to look at your cost structure and figure out how to right size this thing, because the cost of capital is just going to be really, really expensive. Powell said he'd rather overcorrect and break things because he has a toolbox to fix the broken bones, but he doesn't have a toolbox to fix if they undercorrect and they have rampant inflation. I mean, not more explicit you can't get, Jason. So he's going to take rates until demand is destroyed and enough demand is destroyed such that inflation is tamed. But that has huge implications to all of us because we all have to do our job trying to build a company, trying to raise money, trying to invest money. It's just getting much, much, much harder than I even thought. So for me, I'm like, wow, I thought that we could get through the worst of this by mid-23, but now you have to plan for the worst, which means, okay, now I'm thinking that, man, rates could be higher for much longer, which means, we could be in this market till early 25. And you may say, hey, that's way too conservative. Yeah, but you have to plan for conservatism in this point. So how do I invest money right now? Honestly, I'm like, I should just put it more into T-bills. Isn't that crazy? If a company's like, hey, Chamath, can I have another 10, 15, 20 million bucks? I'm like, wow. I mean, I don't think that gets you anywhere. And oh, by the way, that 10 or 20 million dollars, I can generate 4%. What a tough trade-off. I just don't see anybody rewarding hypergrowth that is burning a ton of cash, where you have to be back in market every year, because it's just very hard to feel comfortable that the conditions on the field aren't going to be drastically different a year from now, right? It's not like we know that it's going to be better or worse. And I think that uncertainty is actually really bad for companies. So to your point, it's just like a lot of folks have tried to shy away, David, from actually revisiting their valuations. They've done these complicated converts and they've tried to basically, I think it's sort of like managing their ego or the board's ego. And I think like the next shoe to drop has to be these founders and these boards just saying, okay, let's just take the hard medicine. What's the real, market clearing price and valuation? Let's get a third party to price it and let's get new fresh equity and then move forward. Because if you don't do that and you wait until everybody's trying to do it, then it's going to be a really tough scenario. So better, to your point, this is why like Stripe, it's so smart. Better to cut now. Again, it's always hard to let people go, but it's better to do that now than 18 months from now, because you just have no idea how much more expensive or hard it's going to be then. And who's going to even be in the business of lending money or investing money in 18 months? And that sounds pretty crazy, but it's like, I think that's the moment that we're in.
Chamath goes on to say why it's so important to remain unemotional if you're the CEO of a company and you're trying to navigate cost basis and what direction to take during a downturn. With the value of the dollar decreasing, it remains a challenge to plan and execute a winning strategy with startup companies when you have massive interest rate increases that directly affect your business. Many of the private companies that Chamath purchases have the cost basis analysis nailed down and have found unique ways to maneuver within the volatile market conditions we're seeing now.
But guys, this is just math, It's not a judgment on any of these companies. It's just pure math. This is why I think you have to be utterly unemotional in this moment. And if you're a CEO running a company, particularly a SaaS business, you have to really figure out how to right size your cost basis. If you take a very balanced view of what happened this week, you have to start, I think, with the Federal Reserve. And really what they said is rates will probably be higher than all of you think, and they'll be higher for longer than all of you want. And without debating whether that's going to come to pass or not, the thing that you can do is you can build a little sensitivity model to understand the mathematical implication of it. And basically what it means is that the dollar that's right in front of you is now meaningfully more important than the dollar that's far, far away from you. So let's just assume that, the Fed funds rate goes to 5.5% or so, even 5. Let's go to the optimists and say it's only going to go to 5. Tech companies have to achieve 500 basis points above that minimum. So we all have to generate 10 to 11% returns for us to be on a risk-adjusted basis better than a government bond. The problem with that is all of a sudden, if you're trying to generate cash even 3 or 4 years from now, it's not worth that much. You need to generate dollars today. And so, they are really reprioritizing the value of short-term profits. And that's going to affect how companies get money, the cost of capital, so how much dilution you have to take. So I think this is what companies are now bearing down for. They're realizing, oh man, I need to get my cost structure way in line. It is way better now, just to think about this contrast. It's way better to grow at 20% and be profitable than it is to grow at 100% and burn money, because it's not clear where that second company is going to get the incremental dollars they need for growth. And that's just a mathematical realization when rates are 5%, risk-free rates are 5%. But unfortunately, in a moment where, rates are, again, the risk-free rate goes to 5.5, our cost of capital to do business goes to 10 or 11. These guys have to pay 12 or 13%. My gosh, it's really, really dilutive to be in business right now. So it just goes to show you that you can stay public, but if you want to get incremental money to cover your burn, the only way you can do it without really, blowing up your cap table and doing a massive recap will be through convertible debt. But it has a huge overhang, and you risk turning the keys over to the debt holders of the company. So the alternative for that business is to go into the hands of private equity and get out of the spotlight of these public markets. But private equity is very smart. And the thing that's happened to them is they can't raise debt, right? So what do you think they do? They just have to pay 50% less than what they would be willing to pay before, because they have to write, 100% equity check. So there is no free lunch anymore, I think is the big point to point out anywhere in the market right now.
Chamath acknowledges that generating cash 3 or 4 years from now, when the value of the dollar will be less, requires reprioritizing of short-term profits. This will directly affect how companies get money and is an indicator for investors because they know up front they will be diluted down the line. Chamath believes the Fed's printing, interest rate hikes, and inflation will all play major factors in the market's incremental growth, and so cost of capital is a crucial element to any investor in the current economic landscape. What do you guys think about Chamath's outlook for the current market, and how will this affect investor sentiment in the coming months? Comment down below. Guys, thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.